This quick video, I decided to go live. All right, let me see if I'm doing this right. Let me put it over here. Let me see if I'm doing this right. All right, so yeah, there we go. There we go. All right, so guys, I decided to go live today because I want to talk about something that I thought was pretty important. And is the 11 mistakes that that's keeping a lot of people broke. Right? And I want beginners to be aware. Now, this video is for beginners, but it's also a lot for intermediate people who may be investing for a while in the stock market and just want to make sure you're not making the mistakes. I want you to be aware of some really common mistakes that people make. And for me, guys, I haven't been live in quite a while. It's been about a couple of months since I'm going live. I used to go live all the time. And I'm just getting back to going live. All right. So bear with me. Greetings from Dubai. Good to have you here. Happy Sunday to you. Appreciate you for watching the videos and guys supporting the channel and all that good stuff. That's good. I appreciate you. So every now and then I'm gonna jump back in and do these lives more often. Right. Just stopped doing them a while back because I got busy with a bunch of other stuff. But I'm gonna get back in there. I promise you. We got a big week ahead in terms of the stock market. I said, you know what? I gotta have a conversation with these folks, my folks, about some things to avoid when you're investing. And I keep getting these comments on these videos I put out. These comments about what should I invest in? How should I invest? Should I do this? Should I do that? That's okay. Okay, that's cool. Let's go ahead and do a video that really explains what are some of the mistakes and pitfalls you got to watch out for. Man, got a fire truck going up the street. All right, so 11 investing mistakes keeping you broke. Beginners beware. Now, me personally, just so you guys know a little bit about me, I've been investing in the stock market. I've been literally in the stock market since 1994. What is that? That's 31 years, right? In the stock market. Now, I've been really paying attention back in 94, 95, 98. I wasn't an active investor. I was just putting towards my retirement plan, putting towards and just leaving it. Haven't touched it, right? But it really wasn't until about 2005, 2006 when I started paying attention to the stock market. That was around the time I started doing my real estate investment, a little bit after I started doing real estate investment. And then I've been really in individual stocks only for the last 7, 8, 9 years or so in individual stocks, right? So that's kind of a little bit about my background in the stock market, guys. And by the way, greetings to you guys. Let me know where you're from in the chat real quick, guys, when you get a second. Just give me a shout out. What city, what state, what country, what county, what region, what side of the hemisphere you on, north or south, right? Whatever you're at, let me know, guys. Appreciate it. I always like to give a shout out to folks that are in the chat. Enrico, buy and hold diversity. Good to have you, Enrico. Jimmy's in LA. Good to have you, Jimmy. Got Merlin in the house. I say Maryland, not Maryland. Maryland, Orange County, Republic of Texas, Republic of Texas. Are you trying to say that Texas is breaking away? What are you saying? Georgia's in the house. San Francisco, North Kakalaki's in the house. Good to have you. Rory's in Kentucky, Madisonville. Good to have you here. Sacramento, California. I'm in the Kansas City area. Sacramento took our basketball team about 1985 or something like that. Queens, New York, D.C. in the house, Toronto, Uganda's here, Jerome, good to have you here. We got them all over the world. Chicago, Chi-Town, good to have you. South Side, North Side. Where you at, Calumet? Let's see, Louisville's in the house, good to have you. Sweden from Poland. I'm trying to figure out am I doing this right? Am I looking at the right thing? I'm looking over here, but the camera's over here. Man, I got all this kind of stuff going on. Oakland, California, London's in the house, Sweden's in the house. I might have missed one or two. Don't be mad at me. Somebody is, let's see, Boca Raton, Florida. Germany's up here. We got somebody from Mars. Good to have you. Good checking in from you from Mars. Just kidding. Belgium, Florida. So we're all over the place, man. I appreciate you guys being here. Philly's in here. Kakalaki, Florida, still here. Good to have you. Frankfurt, Illinois. Illinois. Okay. Good place to be. Illinois. France is in the house. Wow. All the way from France. Man, that's pretty special right there. I know it's kind of dark where I'm at, guys. I'm sitting in the shade right now under a tree right here. Let's see here. So let's jump into it. Let's jump into it. LA's in the house. Let's jump into it. Last week, so you know, in terms of the stock market, we had the S&P 500 go up. Thank goodness, right? The S&P 500 went up, and I think it was up more than 5% last week, right? Because we know a couple of weeks ago we had some downturns in the market. But we got a couple of we had 5 straight days in a row, I think, of a positive stock market, a positive S&P, which is wonderful, right? We also got inflation data last week. Inflation data came back lower than expected. Good news, good news, good news. In other words, the prices aren't rising as much as they've been rising. I think it was the lowest inflation had risen year over year. Was it year over year in the last 3 years or so? That was excellent. We had big tech. I took a few notes, right? So you'll see me every now and then just glance at my notes, guys, because I can't remember all this stuff in my head. I'm getting old. All right, so big tech was up. All right, and big tech we know is driving the S&P 500. I'm gonna get to everything I'm gonna talk about, but I want to kind of recap the week real quick. So big tech was up, Tesla, Nvidia, all those, and big tech is driving the market, right? Big tech makes up probably what, 30–40% of the S&P 500. Huge, right? Some people, me included, say that big tech is really taking up too much of the market right now, right? I don't like to see big tech be taking up, 40 and 50%, 30, 40, 50% of the market, because big tech is volatile. And if big tech is volatile, then it means the stock market is going to be volatile, because the stock market is relying on big tech to keep it rolling, right? Also, last weekend, we had U.S. and China suspended tariffs for 90 days. That was a good thing. Doesn't mean it's all wonderful and great. Just means for 90 days, things are chill for a minute. We had Goldman Sachs came out and lowered their recession prediction. Barclays, I think Barclays got rid of their entire recession prediction. So that's a good thing too. Now the bad parts, okay, we had consumer sentiment going down. In other words, this threat of tariffs is kind of spooking consumers right now. And when consumers don't consume, it's not really a good sign for the future of the stock market. Just a heads up. Here's why I'm explaining to you all this, guys. I know the title of this video is 11 Investing Mistakes Keeping You Broke. Beginners beware. Here's why I'm giving you the recap of last week. I'm giving you the recap of last week because you need to know what's going on if you're a beginner investor. I'm not saying you got to watch your stocks every single day, put up 3–4 monitors around you and check in to sit in front of the opening bell for 3 or 4 hours and moving. I'm not saying you got to do any of that, but I am saying you got to be aware. Okay, that's not even one of my 11 things I want to tell you, but that's an important thing to keep in mind. Know what's going on if you're investing in the stock market. Just don't be totally in the dark, right? Just don't be sitting there not knowing anything. Oh, I'm not paying attention. You got to kind of keep a third eye looking at what's going on in the stock market, so you're not just totally blindsided, right? If you're in the stock market, you want to kind of be aware, because if something big happens and you 30% healthcare in your allocation of your stocks or your ETFs, index funds, you're 30% healthcare, and all of a sudden healthcare goes tanks, and you don't know it because you're not paying attention to it, and it tanks for years, and you just sitting there never knowing, right? So I just want you to be aware. Now let's jump into it, right? Let's jump into it. First things first. Number one, the first investing mistake you don't want to make as a beginner, you got to be aware of this, is please, and this is huge right here. I know everybody watching this can probably relate to this, right? Don't buy a stock because I tell you to buy a stock or because I say a stock is good. Don't, listen, you guys got to realize this, okay? I'm pretty raw with what I'm gonna tell you, okay? I don't like to sugarcoat stuff, and you can tell by the videos. If you check out the videos on this channel, I don't sugarcoat stuff. I'm not trying to make money off you. I'm not trying to. I don't even have really. I don't have a sponsorship, and I'm not doing no brand deals. There's no commercial that you'll see that I'm promoting in this video. Now, down the road, maybe I will do a brand deal or something, but I just don't do them right now, right? So I'm not trying to sell you anything. I'm just giving you information, okay? And if you get value from this, guys, do me a favor and hit the like button below for me. That really helps out. And I'm trying to keep this this camera steady, so bear with me on that. So number one is don't buy a stock because I say buy a stock, or don't buy a stock because your favorite YouTuber came on and said, hey, buy this stock. I really like, here's 10 stocks that are going to skyrocket this week. Here's 5 stocks that you got to invest in before the end of the month. Listen, that's not investing. When you take that advice and you go buy the stock, that's not investing. That's more like speculating. That's straight up, flat out, unadulterated gambling, pretty much, right? My point is, number one mistake that a lot of folks make, especially in the beginning, is they don't do the thorough research that you need to do, right? You got to do your own due diligence. And I know it's windy out here, man. I just got a wind gust right here. Bear with me. Let's see. Somebody says I'm diversifying into crypto. I'll jump over to these comments every now and then. Somebody said don't watch Bloomberg. Listen. Stop taking advice from YouTubers and then blaming YouTubers when they go wrong. YouTubers ain't no authority on stocks, okay? You can have a person that's been investing in stocks, not investing. You can have a stock broker who's been a broker for 20, 30, 40 years. They make mistakes too, right? But it's not the YouTuber's job to give you the right stocks. This is your money, right? It's your money. You got to do your own due diligence, right? Don't rely on Smart Money Bro, or you fill that name in whatever who you want to fill it in, right? I'm not gonna get it right all. I don't even suggest stocks for that one reason, because I don't want people saying, "Oh, you told me to go buy this stock, and so you were wrong, and you lost me $40,000." Look, I don't even recommend it. But if I did recommend stocks, don't just take my word for it. I'm not sitting in the offices at NVIDIA. I'm not sitting in the offices at Broadcom and knowing what's going on with all these different companies, right? The research that I do is the same research available to you, right? So your investing is your responsibility. Don't be a lazy investor, okay? What is a lazy investor? Oh, I saw that on Kramer. Let me go buy 25,000 shares. No, that's not it. Don't do that. That's all I'm saying. Number one is don't do that. Do your own research. Number two, and by the way, guys, if you saw the thumbnail to this, I had a black eye on the thumbnail. That wasn't really real. That was just me saying that if you make these mistakes, you're going to get beat up. Okay. So just so you know, right? I don't have no black eyes or nothing like that. You guys tell me, am I looking at the camera right now? Man, it's been a while since I did a live. Okay. Number two, you got to create a plan. Number two is you have to create not just a plan, but you got to create your own plan for investing. Now, when I say your own plan for investing, I mean you got to figure out your own mission, your own goals, your own core values when it comes to investing. What do you believe about businesses? What do you believe about what do you believe about stocks in general, the stock market, right? You gotta, and I've done a few videos where I showed you guys my whole, my whole spreadsheet, right? My Google spreadsheet. It has my strategy, it has my goals, it has my mission, it has my vision, it has my core values, it has my strategy and how I'm going to actually approach and all that good stuff. And it has my evaluation criteria. I also have a spreadsheet that has kind of my stock checklist, right, for when I purchase stocks, right? You got to come up with all that for you, and it's going to be different for each one of us, right? So, in other words, let's put it like this. You got to put in the time and the effort to be an investor, okay? One of the big, is this number two? This is the second big mistake. People don't take the time to really put in the effort to create a customizable individual plan for investing in the stock market. Whether it's ETFs, index funds, individual stocks, bonds, treasury, T-bills, whatever. You have to come up with a plan, a strategy that works for you, right? Again, with this number two, don't be a lazy investor, okay? Don't be lazy when it comes to the money you're trying to grow, right? Number three, third one, you have to evaluate when you're doing your evaluations. This is why I like ETFs better than individual stocks. Individual stocks take a whole lot more time and effort. But if you're investing in individual stocks, you have to do your quantitative and qualitative fundamental analysis of every single stock company that you want to invest in. That's my suggestion. And it really, that's my opinion. It's my suggestion. I stand by it. Some people that you watch on the internet, they're going to tell you, well, no, you just read this and understand this and know that, and you're good to go. No, I'm telling you, dig in. Again, don't be lazy. Dig in, right? Qualitative is the management. I think I have 3 M's. The management, is the management of the company competent? Is the management of the company known for making good decisions? Is the next one is, I'm talking qualitative. The market, know the market. What is the industry you're investing in? Okay, let's say you want to invest in waste management, right? Industrial firm that, if you want to invest in waste management, do you know the industry? Do you understand how waste management makes money? Do you understand, let's say you want to invest in, give me another one, Procter & Gamble, right? What industry is Procter & Gamble in? What is the outlook of that industry? Is Procter & Gamble in your circle of competence? I mentioned before earlier, healthcare stocks, right? Or let's say pharmaceuticals, right? Do you know pharmaceuticals? Is pharmaceuticals in your circle of competence? Do you know how pharmaceutical companies make most of their money? Do you know how they lose money, right? So you got to know the market. You also have to know the moat. We're talking about qualitative stuff that you should know from every single stock you invest in. The moat. What is the moat? What a moat is just like the water that surrounds a castle, right, to protect it. What is the moat of Procter & Gamble? What is the moat of this particular pharmaceutical company? How can they separate themselves from everyone else? What is their competitive advantage, right? If you're investing in Procter & Gamble, what's Procter & Gamble? What is Heinz Company? You know, they make the ketchup and all. What is Heinz Company's competitive advantage? What's NVIDIA's competitive advantage? What's Super Microcomputer's competitive advantage? You need to know that before you plunge $10,000 or $100 into the company, right? Remember, you're investing in a business, so you got to know a little bit about the business, not the numbers, right? We talking about qualitative. Also, you have to know the quantitative stuff about the stock, about the individual company. And this is, again, individual stocks are more time intensive if you really want to do them right. Earnings, right? The net income of the company over the last quarter, their 10Q, right? And a 10Q for beginning investors is just a quarterly earnings that shows how the company is doing. Every company that's publicly traded is required to file a 10Q with the SEC. A 10K is their annual report, right? So you want to be checking some of those things. And really with the annual reports, I like to read the footnotes because you get a lot of information in the footnotes, right? Let's see here. Somebody said, okay, so yeah, I'm just flowing, man. You know, I'm just talking. But the thing is this, quantitative is the numbers. Qualitative is this everything other than the numbers. So the quantitative is, like I say, earnings, free cash flow, what type of debt the company is in, you know, their operating expenses. You want to know all those types of things about the company. Earnings per share, price to earnings ratio. And I'm not going to dig into all those, what those things are on this video. I'm just saying the mistake that a lot of people make, especially beginning and intermediate investors, is they don't look at some of the numbers and they don't look at some of the qualitative stuff. They just push that to the side like it's not important. And what you're really doing when you don't look at that stuff is you're increasing your risk of investing in that particular company. Like everybody hopped on NVIDIA, and they hopped on NVIDIA, and NVIDIA was like, okay, but people weren't really looking at the numbers. People was just looking at the growth and the hype around it. Don't focus on the hype, focus on the company, right? How the stock is performing, how the company is performing, how the management's performing, if they have a competitive long-term advantage. And let me just say this, because I really didn't say this up front, and I probably need to. Everything I'm telling you is based on long-term investing. It's not based on day trading. It's not based on selling options, you know, puts and call covered calls. It's not based on any of that. What I'm telling you is based on long-term, really value investing, meaning you're going to hold these stocks for a long term. So you really want to make sure you know these things. Let's jump to number 4. What did I say number 4 is? I told you I was going to be looking at this. All right, number 4 is this. Number 4 is this. If you don't completely understand everything I just talked about in number 3, you're not ready to invest in individual single stocks. Kind of weird, I know. But number 4 is, if you don't know what I'm talking about when I say, what is the company's EBITDA? EBITDA. What is that? If you don't understand what I mean by what is price to earnings ratio, if you don't understand what free cash flow is, FCF, if you don't understand what is a 10Q and what is a 10K, and where do I find them on every publicly traded company's website, roughly? Usually, so you know, it's in the footer typically, right? And they have earnings and so forth in the footer that you can pull up. But my point is this: if you don't understand that stuff, you ain't ready. Stick with ETFs and index funds. And there's nothing wrong with ETFs and index funds, and there's nothing wrong with not being ready. It's nothing wrong with not wanting to know all that stuff, right? But I'm telling you, if you don't understand it, you're just gambling for the most part. You're winging it. You're kind of guessing based on other people's information. And I don't like to rely on other people's information when it comes to my money. If I'm dropping $10,000 or $5,000 or $2,000 or $1,500 into something, I kind of want to know it, a little bit about it, right? So again, it's not a big deal if you don't know it, guys. It's not a big deal. When you haven't investigated the qualitative and quantitative aspects of a stock or a company, you're basically handing somebody your money and saying, here, do what you want to do with it. I don't know much about you, but take it. I mean, would you hand $2,000 to just somebody, just some random person, say, hey, here's $2,000. I want you to bring back $3,000 in 6 months, and not know what they're going to do and where they're going to do and how they're going to do? That's not me, right? So you got to know all that stuff, right? You got to take some educated risk. I get it. But you just got to know your stuff. Number 5 is this. The 5th mistake that a lot of beginning investors go through, guys. Guys, if you're getting value from this, do me a favor and hit the like button real quick. If you're watching this on the replay and you're getting value, drop a comment or something down below, guys. Let's see here. Somebody said the 3 M's: management, market, moat. James, James got his pen and paper out. I ain't mad at you, James. That's good. That's good. I like that. So number 5 is this. I got 11 of them. You got to get information. You got to learn. And this is piggybacking on number 3 and 4. You have to read books about investing, right? You got to read them not just to understand, not just to feel good about, oh, I got a bunch of books. I got this book. You got to read the book, right? Because I'm guilty myself. I got books in my house that I haven't read, right? But I want to read them, and it feels good to have them, but I got to read them, right? So you got to learn the game, right? And I know it's old-fashioned. I know it's old school when I say you got to read and you got to get information, but reading is still fundamental. You still got to read. You got to read the articles. You may not read a whole bunch of books necessarily, but it's nothing wrong with reading a good book about investing once a month, or a good couple of 3, 4, 5, 6 books a year about investing. So you're building up your knowledge base. A lot of times with new investors, they do so much other stuff. Yeah, they invest a little bit of money, but they do so much. They spend their time doing so much other stuff that they really don't understand what they're doing in terms of investing, because they're not learning about it. They're not being intentional about learning about investing. Information is still power, right? Because here's the deal. When you read and learn about stock market and stock market investing, it helps you make more informed decisions. And it also helps you get a better feel for historical perspective. So if you read, A Walk Down Wall Street or some other book that's been around for 20, 30 years, and you add that to your library, and you add it to your arsenal, it gives you a long-term perspective of the stock market. And when you get a long-term perspective of the stock market, it helps you make better decisions today, right now, about the stock market, right? Because listen, the stock, like I say, this is long-term investing. And you got to have a little bit of information about the history so you don't mess up the future. I'm not saying you got to live in the past and you got to breathe the past, but if you know a little bit about the past, it helps you moving forward. That's in life, that's in anything. And it's really true about the stock market. When you read and understand about what happened in 2000, right? Dot-com bubble. When you read and understand what happened in 1930, right, with the stock 1932 or so with the stock market crash, 1974 with the effect of oil prices and the embargoes and so forth, and how that affected the stock market. Or you read what happened in the 80s with the stock market, what happened in 2008, 10, what happened in 2000, right when the pandemic started, 21. Like, if you understand those things because you read about them, it's going to make you a better investor moving forward. That's just, that goes with anything, right? You understand how your family's health, then it makes you understand what's going on with your health today and how you can prevent mistakes moving forward with your health. Like, it that goes across the board, understanding the past, right? So read. Number 6 is this. Number 6 is, if you're investing, one of the big mistakes that people don't use, that people mess up with, especially in beginners and intermediate people investing, is they don't stay consistent over a long stretch of time. They quit too soon. Everything goes south. They start. I know people that just 3 weeks ago, when the market went way down, had a boom, boom, and went way down. I know people that, sorry about the wind and the gust of wind. I know people that pulled all their money out. And I'm saying, okay, the stock market went down for a couple of weeks and everything looked bleak, but you just pulled all your money out. Now, as I said in the beginning of this video, we had 5 great days in a row. Now, if you made a mistake and you went out of town somewhere and you had your money still out of the market, you missed those 5 great days. Don't do that, right? Dollar cost consistency over time is what makes long-term success in the stock market, right? Dollar cost average, which means for beginners, just simply putting a set certain amount in the stock market, no matter what's happening in the stock market, on a consistent basis. Once a week, $100 for 20 years, right? Once a month, $500 for 30 years, for 10 years. That's dollar cost averaging, right? That's being in it for the long haul. Don't be a day trader is all I'm trying to tell you. I've never been a day trader. Even when I was investing in real estate, I wasn't flipping, right? I wasn't wholesaling. I was buy and hold. That's just my thing. That's what I'm comfortable doing. But you got to give compound interest. It's a beast, right? But you got to give compound interest some time to work. And don't try to time the market, please. This is kind of the same thing. Be consistent. Don't time the market. I did a video a few weeks ago where I said that there were 2 or 3 studies, 2 studies that I know of. I think I read 2 of them that said if you missed the top 20 days in the stock market over a 20-year period, if you missed the top 20 days, your returns are cut in half just because you missed the top days, the top 20 days, right? So my thing is, you stand a huge chance of missing those top 20 days when you get out of the market because you get nervous or you get scared or you get some fear, right? Don't do it, right? Just be consistent over a long stretch of time, and maybe that will cause maybe that means that you have to kind of, if you're an emotional person, emotional investor, that's a problem. Maybe you don't watch the stock market information all the time. You check in on it once a week or once every couple of weeks, and that's it, right? If you're an emotional person. Number 7, only invest in the stuff that you know, right? A mistake that a lot of people do is they invest in stuff because they hear it's a great stock. They don't know nothing else about AI. But, for example, they don't know nothing else about AI, but they just heard that, you know what? That doggone NVIDIA is a good one to invest in. They heard it. They don't know nothing about the chips. They don't know nothing about data centers. They don't know nothing about quantum computing. They don't know anything about the things that AI is actually, what NVIDIA is actually doing in terms of AI and the innovative things that they're coming up with, and how they are outfitting the largest companies in the world like Amazon and Google, how they're outfitting them for the next 5 years with NVIDIA products, right? You don't know anything about AI, but you just heard NVIDIA was a good place to invest your money. I'm telling you, if you don't understand it, don't put your money in it. Now watch this. If you want to understand it, cool. Go research it, go read, go learn, go get information, and then invest in it, right? Or not or, that's it, right? You don't need to be investing in stuff that you don't quite get. Look, I don't invest in Tesla, right? I'm just telling you flat out, I don't own any Tesla. I don't plan to own any Tesla. But the reason I don't own Tesla is because I don't really understand that space. You know, the Starlink and the other stuff they do, and the spaceships and the EVs. That's not really my thing, right? And if it's not my thing and I don't get it, I don't invest in it. On the other hand, I fully understand NVIDIA. I understand their model, how they make money, the things that they're into, etc. Now, I had to learn a little bit about NVIDIA, right? Because I wasn't an AI guy necessarily. But I decided I wanted to invest in it, but I didn't want to invest in it without knowing about it. So the point is, only invest in things that you understand, the things that are in your, what Warren Buffett would call your circle of confidence, right? I'm sorry, competence. Your circle of competence, but it could also be your circle of confidence too, right? Look, if you know about utilities and you know about the energy company, maybe you work for an energy company for 25 years. Okay, you kind of understand it, right? Maybe you work for, like I say, you work for pharmaceuticals, as pharmaceutical sales rep. You understand how they make their money. Maybe that's where you want to invest some money. Cool, right? You a retail person. You worked at Walmart for 30 years. You understand Target. You understand Walmart. You understand Walgreens and CVS. Maybe that's where you want to invest your money. Know something about the industry or learn something about the industry. Your advantage. Let me just drop this on you real quick. Okay, your advantage as an investor. Your advantage as an investor. My advantage is our experience, right? What am I looking at? Right here. Okay. So our experience. If you have experience, say in real estate, like I have 25 years of investing in single family real estate. So I understand commercial and single family real estate pretty well, right? So I own a couple of REIT ETFs. But if you don't understand real estate, maybe you shouldn't be you shouldn't be investing in real estate. You shouldn't be investing in REITs. Like you wouldn't go buy an apartment complex and don't know anything about real estate. Excuse me, or haven't learned anything about real estate. Same thing holds true, excuse me, with the stock market. But if you have the knowledge, excuse me, guys. Excuse me. Sorry. Woo! I'm getting all hyped up. But the knowledge you bring to the table is your competitive advantage as an investor. Okay? Let me move on to that from that one. Next one is number 8. Number 8 is risk what you can afford to lose. I know that sounds like really, really basic, right? Really, really basic. But you would be shocked. You would be surprised at how many people invest money, but it's the only money they have, right? They're investing their emergency money. They don't have any they got $500 in a savings account, but they're investing a lot of money. So they're really desperate for the money to actually make more money quickly, fast, etc. So many people invest money that they don't have, that it would really floor you if you really understood what I'm saying. If that's you, and I just did a video about this, guys, you can check it out. If that's you, where you don't have an emergency fund, you got a whole bunch of bad debt, and you're trying to do a whole lot of investing, beware. Huge, huge mistake. Invest when you're ready to invest. Don't be out here speculating with the rent money, right? Don't be out here speculating with the money that's, and I know that sounds like, who would do that? There's a lot of people that do that, right? They just invest. And they think that they're winning the game by investing. But if you're investing and you don't have money to change your tires, if all 4 of your tires go out right now and you don't have $1,200 sitting around and you're investing, you're really battling backwards, right? Let me say this while I'm on this realm. Make sure that this is kind of a bonus right here. Make sure that hold up. All right. let me say this. Make sure that you invest enough money, right? Don't be, okay, if you got all your stuff together, your foundation is laid, right? You got all your emergency fund ready, your debt's paid off and all that good stuff. Stop being scared to invest more money. This is kind of a bonus. This ain't one of my 11. Don't be satisfied with just getting the match at the job. If you got all your other financial stuff together in life, get off of this idea, this scarcity, this fear of investing, right? I keep going to my eyes, man, because my eyes are watery. All right. I got bad lighting. That's better lighting right there. I've been over here. Y'all should have told me I was dark, too dark. All right, so don't be satisfied with only investing 3% of your money, 4% of your money, 5% of your money, right? One of the biggest mistakes I ever made in terms of investing, I don't like holding it right there. All right. Where's it at? Boom. One of the biggest mistakes I made with investing over the last 25, 35, 30 years, one of the biggest mistakes I've made is by not investing enough money. I skimped around 3 to 5% for a long, long time, right? I didn't stretch myself more sooner. If I had stretched myself, let's say if I had maxed out my retirement account at my job, I'd probably have twice as much money as I have right now invested. So don't be afraid to stretch yourself when you invest. If you are a new investor, a young investor, right? Let's jump to number 9. All right, I can go on for days, guys. Let me see what we're talking about in here. I don't see no chats. All right, but I'm still up. All right. Oh, don't forget, guys, hit the thumbs up button for me. Please hit the thumbs up button for me. Don't forget to smash the thumbs up button for me. I appreciate it. If you're watching this on replay, drop a comment below. Let's go to number 8. I got 3 more of these. I'm sorry, number 9. Please, if you're a beginning person, don't forget to diversify your investments. When you look at your allocation of your investment, this is a piece that a lot of people that begin, they forget about. How do you want to allocate your money? Do you want to allocate it by sectors in the stock market, right? You want to have some in family, some in industrials. You want to have some in tech. You want to have some in healthcare. You want to have some in financials. How do you want to allocate it, right? Also, do you want to, or do you want to allocate it in terms of value stocks versus growth stocks? How do you want to separate your portfolio in terms of ETFs, index funds versus individual stocks or bonds, right? What is the separate? How do you want to separate and allocate the things that you're investing in, right? So you want to be diversified to an extent. How much of your overall net worth portfolio or portfolio in general is real estate and how much is stocks, right? Think about the allocation of your money that you have invested. You don't have to, please don't have all your money in one stock. Please don't have all your money in two or three stocks. Spread it around. This is another reason I like ETFs better than individual stocks, because ETFs are by default diversified because you have your money in a bucket full of different stocks, 80, 90, 100, 200, 500 stocks, right? So diversify. Be intentional about diversification and allocation, right? Let's see what we got here. We got a bunch of folks chiming in, man. And normally I do look at the chat, man. I just haven't been looking at it, guys. Let me also say this, guys. Yeah, somebody said smash the like button. Let me also say this. And I haven't talked about it. I don't even mention it much, and I probably should. But look, I do one-on-one financial mentoring and coaching. I will put a link to that below, and you can check that out. I don't think I have a link right there right now, but it will be there as soon as this goes on YouTube. Check that link out. Everybody's situation's individual and different. And so I do spend a little time helping people individually with their personal, all the things we're talking about in terms of stock market, right? So feel free to check that link out below as well. Great information. I spent about 90 minutes to 2 hours with you. Sorry about the wind. 90 minutes to 2 hours with you, sharing screens, looking at your personal financial situation, your individual, because a lot of times we do these videos on YouTube, and guess what happens? Everything I'm speaking to is general information, but you might have individual questions, and you got an individual situation that is different than somebody else. So it's hard to really do these in general, and sometimes you need that personal one-on-one, so that's why I offer that. And there's a link to that below, so please check that out if you want some help with your own personal situation, or you have a question that you don't want to have to go out and hire an advisor and spend $300, $400, $500 on an advisor or something like that. I have a way that you can help. You can get information from me and put another set of eyes on your situation, which is always important. So, number 9 was diversify, right? And allocate, right? Different stuff to different places. How do you want to chunk it up, right? Right now, I'm about 40% real estate, 60% in the stock market equities, right? But how I'm broken out into those 60% equities is I break them up in different ways, right? But that's what you need to be thinking about. And a lot of times beginners don't think about that, and they lose out because of that. Number 10 is this. Remember this, guys, always. Losses happen. Losses happen. When it comes to the stock market, losing is a part of the game. A lot of times beginners, they just assume that they're always going to win. They're always going to make money. And if they don't make money, the first thing they're doing is panicking, right? Even the most experienced investors of all time, they face losses. You're going to face a loss. Listen, you can't avoid risk in this money game. All you can do really is manage risk, right? Prepare and manage risk and mitigate risk. Lower your risk. For example, investing in Tesla by itself is riskier than investing in Tesla in the S&P 500. Risk is still there with both of those ways of investing in Tesla. All you've done by investing in the ETF that includes Tesla is you've lowered the risk. But there's still risk, right? ETFs and index fund are not automatic. There's still risk, right? Specifically, upside risk, right? So when Tesla goes from 200 per share to 500 per share, if you owned it individually, you got all that. If you owned it in an ETF, you didn't get all that. That's part of the upside risk of having an ETF or index fund, right? Or having, so you get what I'm saying. Risk is always there. And with everything you do with money, always consider risk. I don't think I've seen 10 videos on YouTube that really dig into risk mitigation when it comes to the stock market and how to avoid risk and how to, you don't see those type of videos often, right? You'll see the video says, buy these 10 stocks and it'll make you $1 million. Listen, cool. That's clickbait for the most part, right? But I'm saying mistakes are inevitable. You're going to make poor decisions, right? The key is to learn from the mistakes that you make in terms of the stock market, right? And improve as an investor, and don't worry about the mess ups, because the mess ups, you got to dust yourself off. You got to be I'm a basketball guy, right? So, if I got a shooter, if I'm coaching a shooter, I know they can shoot real well. The one thing I tell the shooter is this: you got to have short memory as a shooter, right? You can't be thinking about the last shot you missed every time you put the ball up and shoot the ball. You can't be thinking about that. You're going to miss the next shot if you're thinking about the last mistake. So you just learn and practice and get better and better, and then you keep shooting, right? As an investor, keep investing. You're going to make some mistakes here and there. Things are going to work out, but you're learning every time you make that mistake. That's the kicker, right? Let's go to number 11. Number 11, if you got value, again, hit the like button for me. Smash the like button for me, and feel free to drop a comment on the video. Number 11 is huge for beginners. Let me see what we got in the chat real quick. Risk management is key. Let's see here. Boom. We got a lot of folks talking in it. Man, do I got to get rid of anybody in the chat? Okay, no, we don't have to get rid of anybody in the chat. I think we're good. If we're not good, let me know. Yeah, we got a couple of idiots in the chat. Let me see what I can do. Boom. Let me get that person up out of here. I always like looking at the chats. People that act silly in the chats, man, they crack me up. There's somebody. There's somebody. Let me go ahead and hide the user from the channel. I enjoy folks that come into the chat and act pretty silly, right? You got to get them out of there. You got to get them out of there. I gotta hide this. I gotta get rid of this person. Got rid of them. Boom. Got them out of there. Ooh, this is fun. All right, so let me keep going. Number 11 is this: do not panic, new investors. Don't make the mistake of panicking. Okay? Here's what happens when you panic. You first of all, you invest money, cool. Stock go up, stock go down. Stock goes way down. If you panic, like people did a few weeks ago, you sell when everything's low. You panic and you get out when things are low, which is the exact opposite of building wealth. And it's also trying to time the market, which I told you before is not a good thing. Don't get rid of your stocks when everything shoots down. Don't do it. That's what when you panic, you got emotion, right? Panicking and getting upset or getting hyped and getting too low and sad and upset and mad. Those are all emotions. Take all your emotions when you invest. Take all your emotions, toss them out the window. Panicking is an emotion. Every time you inject the notion of emotion in investing, you make a mistake. You don't want to be an emotional investor. You don't want to be a person that panics. You don't want to be a person that, oh my gosh, what am I going to do? Oh, I'm mad at Trump. Trump did this. I'm angry. I'm upset. Oh my gosh, forget that. I'm moving all my money out of... You're just making an irrational decision. You're panicking. Don't panic, right? There's going to be market volatility. When we graph the stock market, it looks like this. Let me start over here. Let me start to do this right. It looks like this. Boom, down, up, down, up, down. You don't jump out on the downs, because ultimately we started here, we're going to end up here in 5 years. We started here, we're going to end up here in 10 years. So just hang in there with the downs, right? Where am I looking? Right there. Hang in there with the downs, right? But when you panic, you sell on the downs and you sell low. That's a problem, right? That's how you lose money in the market, right? You have to be prepared for the psychological ups and downs. And if you're not prepared, buy good solid stocks, buy good solid ETFs and index funds and stop checking the market every 2 seconds. If you're not prepared, if you can't handle the psychological, emotional roller coaster, get off the roller coaster, right? I don't ride roller coasters because I don't want to deal with the psychological, emotional ups and downs of being scared and fear and all that. I just don't ride them, right? But it's these emotions that real investors are relying on to make more money. They rely on you being emotional so that they can just swoop in and make money when I'm just telling you how the game works, right? Right? I'm just telling you how the game works. Listen, I hope this video was helpful. I'm not going to stick around here and be on here very long. I didn't want to make it this long of a live, but I did because this is important information. We got a lot of new investors out here, and I see so many mistakes that it's almost painful, right? I see so many mistakes, and I try to steer people away from the mistakes in terms of investing. And like I say, I've been in the game for a long time, and I've been investing in individual stocks for under 10 years, right? Under about 8 or 9 years, individual stocks. But I'm very, very careful with how I invest. I'm very intentional about it. And I'm not emotional with it. Take those out of there. I have a plan. I have a developed plan. And right now, look at year to date, I'm above the S&P 500. I'm doing better than the S&P 500 in my own individual stock portfolio, my individual stock portfolio. I have an ETF index fund portfolio as well. But I'm up. But I'm not saying that to brag. I'm saying that to say that I'm very measured with what I'm doing. And I'm trying to explain that to you. If you want to be a good investor that's starting off, that's new or intermediate, you have to be very measured and very intentional, and not just some fly-by-night lazy investor who doesn't do research, doesn't understand, doesn't read, listen. That's a recipe for emotions. It's a recipe for disaster, because you're just guessing on somebody else's. You're looking over on somebody else's paper cheating, right? Remember the 12th grade? You sit by the person who's really, really smart on purpose so that could rub off on you. And when you take the test, you checking out where they marking, boom. boom, right? You checking out. When you invest like that, like what I'm telling you, and you don't do your research and you don't do all the stuff I'm telling you, you're just cheating off somebody else's paper. You looking at Kramer's paper. You looking at your favorite YouTuber's paper. But you really don't know the stuff. And if you really don't know the stuff, you're going to go out and try to do the stuff and you're not going to know what to do. Right? Or they're going to be wrong and you're going to be mad at the YouTuber who's wrong when you was the one who was cheating off their paper. I hope that makes sense what I'm telling you, right? I hope that makes sense. Listen, don't forget, down below, the link will be, hit me up for a one-on-one. Let's have a conversation about your own personal finances. Also in the links below, you'll see Patreon. Feel free to join our Patreon as well, right? I do VIPs. The VIPs on Patreon, we do once a month individual calls if you join the VIP on Patreon. But listen, if you got value, hit the like button for me. And most of all, even more important than hitting the like button is share the video with a couple people you know, right? Share it, push it out for beginner investors. Maybe you got an older person, younger person, somebody who's thinking about investing, not quite sure. Please send them this video. All right, let me see what we got in the chat, guys. Before I get out of here, let me give a few shouts out. Let me put something in the chat. Let me see what I got. And maybe I can give a shout out if the chat comes up, but the chat ain't came up. There you go. Somebody said, Tawanda, shout out to you. Appreciate you. Dave, appreciate you. Warrior Rebel, thank you so much. M. Dwyer's in the house. Miss Audi is in the house. Joe, appreciate you, Joe. A1 Steak, thank you so much for being here. D. Wilson, Run It Up. Andy, Ghostface is in the house. Aaron Wins. Appreciate you guys being here. Listen, as I always say, I'm going to get back and do more. If you want me to do more of these lives, let me know, right? Don't just give me a thumbs up. When this thing goes live in 30 seconds, I want you to go over there, drop me a comment and say, yeah, we need more lives about topics like this or about whatever topic you think about, right? Let me enjoy this beautiful day. I'm going to go ahead and get me a little walk, try to get me some sunshine on this melanin and go from there. Listen, the best person who's going to take care of the old you is the young you. The you today. You're going to feed the old you. You're going to house the old you. You're going to put clothes on the back of the old you. Guys, take good care of yourself and take care of other people. Until the next video, peace.